Before we begin, please be aware that the content in this presentation is for informational and educational purposes only. It should not be construed as financial, investment, legal, or tax advice. The cryptocurrency market is highly volatile and carries significant risk. You should always conduct your own thorough research and consult with a qualified professional before making any financial decisions. I am not a financial advisor, and the views expressed in this video are my personal opinions based on my own research and analysis. Past performance is not indicative of future results. Remember 2021? It felt like you couldn't escape it. Your Uber driver was a Dogecoin millionaire, your cousin quit his job to flip monkey pictures, and every other ad on TV was Matt Damon telling you that fortune favors the brave. It was a digital gold rush, a frenzy where everyone felt like a genius. Right up until the moment they weren't. And then the music stopped. The crash came and it was brutal. Billions of dollars in wealth gone. People who bet their life savings on projects with cute names and zero substance got absolutely wiped out. Most of them swore off crypto forever. They got burned, they felt foolish, and they decided the whole thing was a scam, a Ponzi scheme, a solution in search of a problem. And that, right there, is the single most expensive mistake they will ever make. Because while they were nursing their wounds and deleting their Coinbase apps, something fundamental shifted under the surface. The tourists left the party, but the builders stayed. The gamblers went home, but the institutions started quietly setting up shop. The quiet tectonic revolution happening right now behind the headlines is about to make the 2021 bull run look like a dress rehearsal. The next 24 months in the United States will not be about hype, memes, or get-rich-quick schemes. It will be about infrastructure, regulation, and real-world adoption on a scale we've never seen before. This isn't another video telling you which altcoin is going to 100x. Frankly, that's a lottery ticket. This is a strategic briefing. This is your roadmap for 2026. We are going to break down the specific, powerful US-centric trends that are set to define the next era of digital assets. We're going to connect the dots between Wall Street, Washington, D.C., and Silicon Valley so you can understand not just what is happening, but why it's happening, and most importantly, how you can position yourself ahead of the curve. Because the game has changed. The players are bigger, the stakes are higher, and the opportunity is exponentially greater for those who understand the new rules. So let's dive into the first and arguably the most important trend for 2026, the Great Regulatory Thaw. For the last decade, the story of crypto in the United States has been one of uncertainty. It was the Wild West. Was Bitcoin a commodity or a security? Was Ethereum a technology platform or an unregistered stock offering? The Securities and Exchange Commission, the SEC, was seen as the big bad sheriff, suing everyone from Ripple to Coinbase, creating a cloud of fear that kept serious institutional money on the sidelines. Why would a pension fund, managing the retirement savings of millions of teachers and firefighters, ever invest in an asset class that could be regulated out of existence by a single court ruling? They wouldn't. It was too risky, too ambiguous. This regulatory fog was the single biggest barrier to mass adoption in the US. But in 2024, the dam began to break. The first major crack was the landmark approval of spot Bitcoin ETFs. This wasn't just another crypto product. This was a Trojan horse wheeled directly onto Wall Street. For the first time ever, any American with a simple brokerage account, a Fidelity, a Charles Schwab, a Vanguard, could get direct exposure to Bitcoin as easily as buying a share of Apple stock. BlackRock, the world's largest asset manager with over $10 trillion under management, didn't just participate. They led the charge. This was the ultimate seal of approval. It was a signal to the entire financial world that Bitcoin was no longer a fringe asset for tech enthusiasts. It was a legitimate, investable part of the global financial system. This wasn't an accident. It was the result of years of legal battles and a slow, grinding shift in the political landscape. We started seeing a surprising bipartisan push for clearer rules. Lawmakers in both parties began to realize that pushing crypto innovation offshore to places like Dubai or Singapore was a massive strategic blunder. They saw the jobs, the tax revenue, and the technological leadership slipping away. Bills like the Financial Innovation and Technology for the 21st Century Act, or FIT21, started gaining real traction, aiming to provide a clear rulebook for the industry defining what makes a crypto asset a commodity versus a security. This political shift is accelerating. Crypto is becoming a mainstream political issue. Candidates are now being asked about their stance on digital assets, and a pro-innovation, pro-crypto stance is becoming a powerful tool for attracting younger voters and campaign donations. The narrative is shifting from crypto is dangerous and for criminals to crypto is the future of finance and the internet, and America needs to lead. So what does this great regulatory thaw mean for you and for the market in 2026? It means three things. First, it means a fire hose of institutional money is about to be unleashed. The Bitcoin ETFs were just the first drip. Next came the Ether ETFs. By 2026, it's highly likely we'll see ETFs for other major assets. But it goes deeper. Regulatory clarity gives the green light for those massive, conservative pools of capital, the pension funds, the university endowments, the insurance companies, to finally make meaningful allocations. We're not talking about a few $billion anymore. We're talking about a potential influx of trillions of dollars over the next decade. When your 401k plan starts offering a 1% allocation to a digital assets fund, you'll know the shift is complete. Second, it means your local bank is about to become your crypto bank. Major financial institutions like JP Morgan, Bank of America, and Goldman Sachs have been building out their digital asset divisions for years, waiting for the regulatory green light. As the rules become clearer, they will begin offering crypto custody, trading, and even yield-bearing products directly to their millions of customers. The friction of using a separate crypto-native exchange will disappear. Buying and holding digital assets will become as normal and as boring as opening a savings account. This is the key to onboarding the next 100 million users in the United States, making it safe, familiar, and accessible through the brands they already trust. And third, it means a boom in American-based innovation. For years, the brightest crypto founders were hesitant to build in the US due to the legal risks. With clear guidelines, that changes overnight. We will see a renaissance of crypto startups and development based right here in the United States, focused on building real-world applications in finance, gaming, social media, and beyond. This will create high-paying jobs and cement America's role as the leader in the next generation of the internet, often called Web 3. So, the prediction for 2026 is this. The regulatory landscape in the US will have transformed from a headwind into a tailwind. The is it legal question will be answered. The narrative will have shifted from risk and speculation to innovation and infrastructure. This clarity won't just make the existing market bigger. It will fundamentally change its character, making it safer, more accessible, and more deeply integrated into the core of the American financial system than anyone thought possible just a few years ago. This isn't a trend. It's the foundation upon which all other trends for 2026 will be built. It's the legalization of a new asset class, and it's happening right now. And with those institutional floodgates now officially open, the question shifts from if they will enter the market to what they will do now that they're here. And the answer to that question is our second major trend for 2026. And it's a concept so big, it's poised to fundamentally rewire the entire global financial system. It's called the tokenization of real-world assets, or RWAs. Now, I know that sounds like a bunch of incomprehensible jargon, so let's break it down. Forget crypto for a second. Think about every valuable thing you can own in the real world. The deed to your house, a share of stock in a company, a bar of gold, a vintage car, a piece of fine art. Right now, ownership of these things is represented by paper certificates, complex legal contracts, and entries in slow, centralized databases. Your house deed is a piece of paper, locked in a filing cabinet at a county recorder's office. It's physical, it's slow to transfer, and it's expensive to manage. Tokenization is the process of taking that ownership and converting it into a digital token that lives on a blockchain. It's like turning that dusty piece of paper into a secure digital certificate of ownership that you can hold in a digital wallet just like Bitcoin. But why? Why go through all this trouble? The answer is simple, because the largest financial institutions in the world are about to do it, and they're doing it for reasons that will end up benefiting everyone. Don't just take my word for it. Listen to Larry Fink, the CEO of BlackRock, the largest asset manager on the planet with over $10 trillion under management. He recently said, and I quote, "The next generation for markets, the next generation for securities will be tokenization of securities." This isn't some crypto influencer in a basement making a wild prediction. This is the most powerful man in finance telling you exactly where the puck is going. He believes that tokenization will lead to, in his words, instantaneous settlement and reduced fees, completely revolutionizing how we buy, sell, and own things. When a firm like BlackRock gets interested in a technology, it's not for the hype. It's for efficiency. It's for profit. The current financial system is an ancient relic. When you buy a stock, the trade might look instant on your phone, but behind the scenes it takes 2 days for the ownership to actually settle. It's a clunky, expensive process involving countless intermediaries, clearinghouses, and banks, each taking a tiny slice of the pie. Transferring ownership of a house can take 30 to 60 days and cost thousands in fees to lawyers, title companies, and escrow agents. It's a system built on paper and trust in a dozen different people. Blockchain technology changes that entire equation. With a tokenized asset, the code is the law. The transfer of ownership is the settlement. It happens in minutes, not days. The need for many of those expensive middlemen simply evaporates. For institutions managing trillions of dollars, shaving off even a fraction of a percentage point in fees and speeding up settlement times by days translates into billions of dollars in savings and unlocked capital. This isn't a choice for them, it's an economic imperative. And that is why this is a 2026 trend. The pilot programs are happening now. By 2026, we'll see the first wave of major institutionally backed tokenized assets hitting the market. So what exactly are we talking about tokenizing? The first and most obvious answer is real estate. Imagine instead of buying an entire commercial building for $50 million, an investment firm could tokenize it into 50 million individual tokens. Now, an investor could buy one token for $1, owning a tiny fractional piece of that skyscraper. But it gets bigger. Think about selling your own home. Instead of selling the whole thing, what if you could tokenize 20% of your home's equity and sell it on an open market to access liquidity, without having to take out a high-interest home equity loan? For the first time, the largest and most illiquid asset class in the world could become as easy to trade as a stock. But it goes so much further. Think about private equity and venture capital. These are some of the best performing asset classes, but they've historically been locked away, accessible only to the ultra-wealthy because of high minimum investments and decade-long lockup periods. By tokenizing a venture capital fund, smaller investors could gain access, and existing investors could sell their tokens on a secondary market if they need their money back early. It shatters the wall between public and private markets. We're even seeing the tokenization of the most foundational asset in the entire financial system: U.S. Treasury bonds. These are considered the safest investment on Earth. And now, companies are putting them on the blockchain. Why? Because it allows investors in other countries to access them 24/7 without going through the slow, traditional banking system. It allows decentralized finance protocols to use tokenized treasuries as stable, yield-bearing collateral. It's taking the oldest, most trusted asset and plugging it into the newest, most advanced financial rails. This isn't a distant science fiction future. The Boston Consulting Group released a report projecting that the tokenization of illiquid assets will become a $16 trillion business opportunity by 2030. That's $16 trillion. For perspective, that's larger than the entire GDP of China. This is the scale of the transformation we are talking about. So what does this mean for you, the average American, by 2026? It means 3 revolutionary things. First, the democratization of investment. The velvet ropes that have kept average people out of the best investments are about to be torn down. You won't need $1 million to be a real estate mogul. You might only need 100. You could own a piece of a world-class art collection, a portfolio of promising startups, or even a share in a new Hollywood movie's future royalties. Second, radical liquidity. The things you own will become easier to buy and sell than ever before. That ability to quickly convert an asset into cash is a form of financial freedom that most people simply don't have today. And third, lower costs. By using smart contracts to automate everything from dividend payments to rent collection, and by cutting out the layers of middlemen, the cost of transacting and owning assets will plummet. More of your money stays in your pocket. This is the true promise of blockchain technology, moving beyond speculative digital currencies and into the fabric of the real world. It's about upgrading the archaic analog systems that underpin our entire economy. The institutional adoption we talked about in the first trend wasn't just about buying Bitcoin. That was just the appetizer. The main course is using the technology that Bitcoin pioneered to overhaul everything. They are building the pipes right now. And by 2026, the first tidal wave of tokenized real-world value is going to start flowing through them. But bringing trillions of dollars of real-world assets on-chain creates a monumental new problem. Where does all this value actually go? Which digital ledger, which blockchain, is secure enough, fast enough, and reliable enough to become the foundation for this new tokenized economy? The battle for that prize, the race to become the trusted settlement layer for the world's assets, is already underway. and the winner will become nothing less than the digital backbone of the new American financial system. And so, the great digital land grab of the 21st century begins. This isn't a race for territory, it's a race for transaction, a battle to become the fundamental rails upon which trillions of dollars in tokenized assets will move, settle, and trade. Think of it like the race to build America's railroads in the 19th century. It wasn't just about laying track. It was about defining the arteries of commerce for 100 years to come. The winners didn't just get rich. They built the modern economy. The same prize is on the table today, and the contenders are lining up. At the center of the ring, the reigning champion, the undisputed heavyweight, Ethereum. If you've heard of anything beyond Bitcoin, it's probably Ethereum. It was the pioneer, the first to prove that a blockchain could be more than just digital money, it could be a world computer. Its advantage is monumental. A lead so vast it's almost unfair. It has the largest, most battle-hardened army of developers on the planet. It has the most applications built on it, the most value locked within it, and a brand name that carries weight in boardrooms from New York to Silicon Valley. When major banks and asset managers first dip their toes into tokenization, their first call is almost always to an Ethereum-based solution. Why? Because it's a known quantity. It has survived hacks, market crashes, and intense scrutiny for years. In the world of high finance where stability is paramount, that track record is worth its weight in gold. But every champion has a weakness, and Ethereum's is famous. It's slow and it's expensive. Using the Ethereum network during peak times can feel like being stuck in Los Angeles traffic at 5 p.m. on a Friday, and you're paying a toll every single inch you move. These gas fees, the cost to process a transaction, can sometimes make small-scale operations prohibitively expensive. This is the fundamental challenge known as the blockchain trilemma. You can have security, decentralization, or speed, but it's incredibly difficult to have all three at once. Ethereum has historically prioritized security and decentralization, creating an opening for rivals who are willing to make different trade-offs. For the tokenization of a $10 million commercial property, a high fee is a rounding error. But for the tokenization of 10,000 shares of a company, or 1 million daily microtransactions, Ethereum's cost structure starts to break down. This is the chink in the armor, the opening that every other contender is aiming for. And sprinting into that opening is the challenger built for pure, unadulterated speed. Solana. If Ethereum is the trusted, established New York Stock Exchange, Solana wants to be the Nasdaq, a fully electronic, high-frequency trading machine. It was designed from the ground up with one goal in mind: to process an insane number of transactions per second at a fraction of a penny each. We're talking tens of thousands of transactions per second, rivaling global payment processors like Visa. This isn't a theoretical upgrade. It's happening right now. This speed makes it the darling of applications that require rapid-fire activity like decentralized social media, gaming, and most importantly for our conversation, high-frequency financial markets. Wall Street doesn't move at a walking pace. It moves at the speed of light. And any blockchain that wants to handle the tokenized stock market of 2026 needs to be able to keep up. Solana's proponents argue that it's the only chain currently capable of handling that kind of institutional-grade load. Of course, this speed has come at a cost. Solana has faced criticism for its network outages, moments where the engine simply got too hot and shut down. Its detractors call it unreliable, a centralized system masquerading as a decentralized one. But its defenders see these as mere growing pains, the necessary stress tests for a network being pushed to its absolute limits. They believe that once these kinks are ironed out, Solana's raw performance will make it the undeniable choice for the American financial machine. But what if this isn't a zero-sum game? What if the future isn't one single railroad, but an interconnected national network? This is the vision of the third type of contender, the interoperability protocols, with the Cosmos ecosystem being a prime example. The core idea behind Cosmos is revolutionary in its simplicity. Instead of one blockchain to rule them all, let's create an internet of blockchains. A future where hundreds, even thousands of specialized blockchains can all communicate with each other seamlessly. Think of it like this: you wouldn't build one massive, inefficient factory to produce everything from cars to microchips to pharmaceuticals. You'd build specialized factories for each, all connected by a robust logistics and transportation network. Cosmos aims to be that network for the digital asset world. A bank might build its own highly secure, permissioned blockchain for tokenizing real estate. A stock exchange might build another, optimized for high-speed trading. A gaming company might build a third for in-game assets. In isolation, they are powerful but limited. But connected through an interoperability protocol, they become a fluid, cohesive digital economy. This vision is incredibly appealing to large institutions because it doesn't force them to bet on a single winner. It gives them the freedom to build their own custom-tailored solutions while still being able to connect to the broader world of digital assets. It's a vision not of a single king, but of a thriving interconnected federation of sovereign chains, each a master of its own domain. Now, weaving through all of this is the critical American thread. This isn't just a global tech race. It's a battle for a strategic foothold in the United States. And when you look closely, you see the American fingerprints everywhere. Many of the core development teams behind these massive projects, from Ethereum supporting foundations to Solana Labs, are based right here in the US. They are actively lobbying in Washington, D.C., hiring from top American universities, and forging partnerships with pillars of American finance. We see Visa testing payments on Solana. We see JP Morgan building its own private blockchain Onyx, based on Ethereum technology. We see asset management giant Franklin Templeton putting its funds on public blockchains. This is the real war, fought not just in lines of code, but in conference rooms and on Capitol Hill. The technology is the ticket to the dance, but the ultimate prize will go to the platform that can best navigate the American corporate and regulatory landscape. It's about building trust with institutions that have been around for centuries, convincing them that this new digital infrastructure is not just innovative, but safe, compliant, and reliable. The winner won't just be the fastest or the most decentralized. It will be the one that Wall Street and Washington can agree on. So we have the established, secure incumbent, the high-speed, disruptive challenger, and the cooperative, interconnected network builder. Each represents a fundamentally different vision for the future of America's financial plumbing. A battle of philosophies as much as a battle of technologies. But here's the unsettling truth that will define this race as we hurtle towards 2026. The ultimate winner might not be determined by which technology is superior. It will be determined by a force far more powerful and unpredictable. A force that can make or break empires overnight. Regulation. Because while these titans of technology are battling for market share, a much larger, more powerful player is watching from the sidelines, taking notes and preparing to make its move. The United States government itself. And it has its own ideas about what the digital backbone of the American financial system should look like. The coming clash between decentralized innovation and centralized control will be the defining story of this decade. And the outcome is anything but certain. And nowhere is this clash more visible, more tangible, than in the race to tokenize the real world. This isn't some abstract, far-off concept. This is trend number 4, and it's arguably the most profound shift we will witness by 2026. The tokenization of real-world assets, or RWAs. Forget just trading Bitcoin or Ethereum. We are talking about the digital transformation of everything of value on planet Earth. Your house, the office building downtown, a masterpiece hanging in a museum, a forest, a portfolio of private company shares. We're talking about taking these physical, illiquid, often inaccessible assets and representing them as digital tokens on a blockchain. Think about it this way. The first wave of the internet digitized information. It took encyclopedias, newspapers, and photo albums and made them instantly accessible and transferable anywhere in the world. This next wave, powered by blockchain, is doing the same thing for value. It's taking the concept of ownership, a deed to a house, a stock certificate, a bond, and turning it into programmable, divisible, and globally tradable code. What if you could own not just a whole building, but a single digital tradable brick of the Empire State Building? What if you could buy a 1% stake in a Picasso, or earn a yield from a loan backed by a fleet of commercial airplanes, all from your phone? That's the promise of RWA tokenization. The benefits are staggering. First, liquidity. Assets like real estate or fine art are notoriously difficult to buy and sell. It can take months, involve mountains of paperwork, and require armies of lawyers and brokers. By tokenizing an asset, you can potentially trade it 24/7 on a global market just like a stock. Second, fractionalization. Most people can't afford to buy a multi-million-dollar commercial property, but they might be able to afford 1/10,000th of it. Tokenization breaks down massive assets into bite-sized pieces, democratizing access to investments that were once the exclusive domain of the ultra-wealthy. And third, efficiency. By using smart contracts, processes like dividend payments, interest accrual, and ownership transfers can be automated, cutting out costly intermediaries and reducing the potential for human error. This isn't science fiction. It's happening right now, and the biggest players in the world are placing massive bets on it. Larry Fink, the CEO of BlackRock, the world's largest asset manager with over $10 trillion under its watch, has said, and I quote, "The next generation for markets, the next generation for securities, will be tokenization of securities." JP Morgan has already used its own private blockchain to execute live trades with tokenized versions of U.S. Treasury bonds. Goldman Sachs, BNY Mellon, Franklin Templeton, the titans of traditional finance are all building platforms and running pilot programs. They see the writing on the wall. They understand that the plumbing of the global financial system is about to get a radical upgrade. And this is where we return to that epic clash between centralization and decentralization. The Wall Street giants see tokenization as a way to create a more efficient version of the system they already dominate. They are building what are known as permissioned or private blockchains. Think of these as exclusive, members-only clubs. JP Morgan decides who gets to use their blockchain. They control the nodes, they set the rules, they approve the participants. For them, it's about reducing settlement times, cutting operational costs, and maintaining their role as the gatekeepers of finance. They want to build new high-speed digital highways, but they plan on owning all the roads and installing toll booths at every on-ramp. But there is a radically different vision brewing in the world of decentralized finance, or DeFi. Crypto-native projects are building on public, permissionless blockchains like Ethereum. Their vision isn't a walled garden. It's an open global bazaar. On a permissionless system, anyone can build an application, anyone can issue a tokenized asset, and anyone can participate in the market, provided they follow the rules embedded in the code. There are no gatekeepers. The goal isn't just to make Wall Street more efficient for the insiders. It's to build an entirely new, parallel financial system that is more transparent, accessible, and fair for everyone. By 2026, this will be one of the most fiercely contested battlegrounds in the United States. The conflict will play out in the halls of the SEC and the Treasury Department. Why? Because every single one of these tokenized assets raises a critical question. What is it legally? Is a token representing a fraction of an apartment building a security? Almost certainly, yes. And that means it falls under the stringent regulations of the SEC. The legal and regulatory clarity, or lack thereof, will be the single biggest factor determining which vision wins out in the US. Will the regulatory framework favor the incumbent permission systems of the big banks, which are easier for regulators to monitor and control? Or will it find a way to accommodate the open, decentralized models, unleashing a wave of innovation but also introducing new risks? This is the trillion-dollar question. The outcome will determine whether the future of asset ownership in America is an evolution of the current system, controlled by a familiar few, or a revolution that opens the floodgates of opportunity to the many. For you, the individual, the stakes are immense. In a future dominated by permissioned bank-run systems, you might find that your mortgage is a token on a Chase blockchain, making it more efficient to manage, but still locking you into their ecosystem. In a decentralized future, you might hold that same mortgage token in your own self-custody wallet, able to use it as collateral on a dozen different platforms around the world to get the best possible loan, without asking anyone for permission. By 2026, this trend will have moved far beyond pilot programs. We will see the first major fully regulated tokenized real estate and private credit markets operating at scale in the United States. You'll be able to go onto a platform and buy a token representing a share of a portfolio of rental properties in Austin, Texas, and start earning your share of the rental income that same day. You'll see funds offering tokenized exposure to venture capital deals, an asset class that has been almost impossible for the average investor to access. The very concept of a portfolio will change. Instead of just stocks and bonds, your investment account in 2026 could hold a diverse array of digital tokens representing slices of infrastructure projects, rare collectibles, music royalties, and corporate debt. The line between public and private markets will blur, and the speed at which value can move and be reallocated will be breathtaking. The battle will no longer be about if real-world assets will come on-chain. The battle will be for the soul of the system itself. It's a fight for who writes the rules for this new digitized economy of ownership. It's Wall Street's controlled efficiency versus crypto's chaotic, open innovation. And all of this, trillions of dollars in tokenized real estate, bonds, and art flying around the globe, creates an astronomical demand for a stable, reliable, digital form of cash to settle these transactions. The system needs a bedrock currency, a digital dollar to act as its lifeblood. But the stablecoin of 2026 looks nothing like the one you know today. The very definition of digital money is about to be rewritten, and the US government is finally stepping into the ring. The bell has rung, and the fight for the soul of the American dollar is on. For years, stablecoins were the quiet, unassuming workhorses of the crypto world. They were the poker chips at the digital casino, the bridge between the chaotic volatility of Bitcoin and the familiar stability of the dollar. But in the background, they were growing into a multi-hundred-billion-dollar shadow banking system, completely outside the purview of traditional oversight. And Washington noticed. The collapse of algorithmic stablecoins like TerraUSD wasn't just a crypto story. It was a fire alarm blaring in the halls of the Treasury and the Federal Reserve. They saw the potential for a digital age bank run, a contagion that could spill over from crypto exchanges into the real economy. The question was no longer if they would regulate, but how and who would be left standing when the dust settled. By 2026, the era of the unregulated, offshore stablecoin is over in the United States. It's a ghost. The Wild West has been tamed, and two new models for the digital dollar have emerged from the legislative fray, each with profound implications for your money and your freedom. The first model is the one Wall Street and Silicon Valley were betting on, the fully regulated, privately issued stablecoin. Think of this as stablecoin 2.0. Forget the opaque reserves and questionable audits of the early days. In 2026, to issue a US dollar stablecoin that can be used by Americans, a company has to play by a whole new set of rules. We're talking about entities that are chartered as special-purpose banks or trust companies, subject to the same kind of rigorous supervision as a Bank of America or a JP Morgan Chase. Their reserves aren't a mysterious mix of commercial paper and other assets anymore. They are mandated by law to be 100% backed, one-to-one, by the safest assets on Earth: cold hard cash and insured depository institutions and short-term U.S. Treasury bills. And these reserves are audited daily, not quarterly, with the results published on a public ledger for anyone to see. This isn't just a promise of stability. It's verifiable, transparent, and legally enforceable proof of it. Companies like Circle, with their USDC, were already moving in this direction, but the new framework makes it the law of the land. It's the difference between a kid's lemonade stand promising their lemonade is fresh and a Coca-Cola bottling plant with FDA inspectors on the floor. The result is a Cambrian explosion of trusted digital dollars. Imagine a PayPal coin, an Amex coin, or even a JP Morgan coin available not just for interbank settlement, but for everyday people. Your digital wallet in 2026 might hold several different brands of dollars, all redeemable one-for-one for the real thing, all competing on features, speed, and integration. Want to send money to a friend? You might use the stablecoin built into your messaging app. Buying a coffee? You could tap your phone and use a retailer's branded stablecoin that gives you instant loyalty points. This model preserves the innovation and competition of the private sector. It allows for a vibrant ecosystem where the best technology wins, all while wrapping it in the safety blanket of federal regulation. It's the government's way of saying, we'll set the rules for a safe playground, but you kids can invent whatever games you want inside it. But this approach has its own critics and its own hidden dangers. Even with 100% backing, you're still placing your trust in a private company. What happens if one of these issuers, now deemed systemically important, faces a catastrophic hack or gross mismanagement? The government might have to step in and bail them out, socializing the losses while the profits remained private. Furthermore, it creates a new set of powerful gatekeepers. A handful of large, federally chartered tech and finance companies would effectively control the primary rails of digital currency in America. And that leads us to the second, far more radical model that has emerged. The one that keeps bankers up at night and privacy advocates sounding the alarm. A direct-to-consumer central bank digital currency, or CBDC. The Fed coin. This isn't just a regulated private token. This is the United States government issuing a digital dollar directly to its citizens. Think about that for a second. Right now, the only public money you can hold is physical cash. Everything in your bank account is technically private money, a liability of your commercial bank. A retail CBDC changes that completely. It would be the equivalent of every American citizen having the option to open a bank account directly with the Federal Reserve. The potential benefits are enormous, and they're what proponents in Washington are championing. Imagine another pandemic-level crisis. Instead of waiting for paper checks or clunky direct deposits, the government could instantly airdrop stimulus funds into every citizen's Fed wallet. It could be programmed to be spent only on essentials like food or rent, ensuring the money goes where it's needed most. For the unbanked, a Fed coin could be a gateway to the financial system, accessible with just a smartphone, bypassing the high fees and minimum balances of traditional banks. International payments could be settled in seconds, not days, slashing costs for businesses and individuals alike. It represents a monumental leap in the efficiency of money itself. But here lies the dystopian bargain. The very features that make a CBDC so efficient are the same ones that could enable an unprecedented level of surveillance and control. With a Fed coin, there is no such thing as an anonymous transaction. Every coffee you buy, every political donation you make, every book you purchase could be a data point on a government ledger. It's the end of financial privacy as we know it. And the potential for control is chilling. What if future legislation decided certain purchases were socially undesirable? Could your digital dollars be programmed to not work at a liquor store, a gun shop, or a fast food restaurant? Could they be given an expiration date to force you to spend and stimulate the economy? Could access to your funds be switched off with a single keystroke if you're flagged for participating in a protest or spreading misinformation? These aren't far-fetched conspiracy theories. They are real capabilities being discussed by central bankers around the world. The CBDC is a double-edged sword. One side offers unparalleled efficiency and inclusion, while the other threatens a level of government control over individual lives that was previously impossible. So by 2026, the United States finds itself at a historic crossroads. The landscape isn't one or the other. It's a tense coexistence. The regulated private stablecoins are thriving, integrated into our favorite apps, making digital payments seamless and fast. They are the user-friendly, feature-rich front end of the new digital economy. But humming in the background is the ever-present reality of the Fed's own digital dollar project. It may still be in a pilot phase, or perhaps only a wholesale version for banks is live, but the retail CBDC, the direct-to-citizen Fed coin, is no longer a theoretical concept. It's a tool the government is holding in reserve, a break glass in case of emergency option that could be deployed if the private market fails, or if a geopolitical rival's CBDC threatens the dollar's global dominance. This dual-track system creates a fascinating dynamic. Private stablecoins are forced to be hyper-competitive and hyper-secure, knowing that if they mess up, the government has a public alternative waiting in the wings. And the government is hesitant to fully launch a retail CBDC, knowing the immense political backlash it would face over privacy concerns. This fragile, competitive balance is the new reality of digital money in America. You, the user, will have a choice. You can opt for the convenience and innovation of a private digital dollar, or you can consider the raw utility and government backing of a public one. But the choice you make is about far more than just technology. It's a vote on where you stand in the fundamental debate between privacy and security, between corporate power and state control. And the outcome of this battle for the dollar will create the very foundation upon which our next major trend is built: the tokenization of everything. Because once you have a trusted, stable, and programmable digital dollar, you can finally start putting every other asset in the world on a blockchain. Stocks, bonds, real estate, art. The very concept of ownership is about to be digitized. And what does that mean, to digitize ownership? It means we're about to witness the single greatest unlock of capital in human history. We're talking about taking the world's most valuable, most illiquid assets, the things that form the bedrock of our economy, and making them as easy to trade as a stock on your Robinhood app. Think about the biggest investment you'll probably ever make: your house. Let's say you own a home worth $500,000. That's fantastic. But that $500,000 is trapped. It's a number on a piece of paper. If you need $50,000 tomorrow for a medical emergency or a business opportunity, what are your options? You can't just shave off the master bathroom and sell it. You have to go through the grueling process of a home equity loan or a full-blown sale, which takes months and involves an army of bankers, lawyers, agents, and inspectors, all taking a cut. Your wealth is illiquid. It's frozen. Now imagine a different world. In this world, your ownership of that house isn't just a paper deed locked in a county clerk's office. It's represented by 500,000 digital tokens on a blockchain. Each token represents $1 of equity in your home. You need that $50,000? You simply go to a digital marketplace, a 24/7 global exchange, and sell 50,000 of your house tokens. The transaction settles in seconds, not months. The money is in your account almost instantly. You didn't have to fill out a mountain of paperwork. You didn't have to pay a team of middlemen. You just access the value of your own asset seamlessly, but it gets so much bigger than that. Maybe you don't sell those tokens to just one person. Maybe 500 different people from all over the world each buy $100 worth of your home. They now own a tiny fractional piece of a prime piece of American real estate. This is the power of tokenization. It shatters massive, monolithic assets into tiny, tradable pieces. This isn't a fringe crypto fantasy. This is the explicit goal of the largest financial institutions on Earth. Larry Fink, the CEO of BlackRock, the firm that manages over $10 trillion, has said it plainly. He believes the next generation for markets, the next generation for securities, will be the tokenization of every single asset. He's not talking about Bitcoin or Dogecoin. He's talking about stocks, bonds, mortgages, commercial real estate, private equity, fine art, carbon credits. Everything. Why are they so obsessed with this? Because the current financial system, for all its digital facades, is still running on ancient, inefficient plumbing. When you buy a stock today, the trade doesn't settle instantly. It takes a full day, what they call T+1 settlement. Behind the scenes, a complex and costly web of clearinghouses and custodians grinds away to make sure the right shares get to the right person. It's a system built in the 1970s, patched over for 50 years. Tokenization rips out that old plumbing and replaces it with a hyper-efficient, transparent, and automated system. A smart contract can do the work of an entire back-office floor of a bank, but it does it instantly with near zero cost, and without the possibility of human error. This isn't just a small upgrade. This is like going from the Pony Express to the fiber optic internet. The cost savings alone will be in the trillions of dollars. So, what does this actually look like in the United States by 2026? This revolution won't happen overnight for every asset class. It will be a phased rollout, starting with the assets that have the most to gain. The first, and arguably the most important, will be the tokenization of U.S. Treasury bonds. This is already happening. Giants like Franklin Templeton have put billions of dollars of their U.S. government money market funds on-chain. Why? Because it offers institutional clients 24/7 trading and instantaneous settlement. By 2026, this won't be a niche experiment. It will be a standard. Expect the market for tokenized treasuries to swell into the hundreds of billions, if not trillions, as every major financial institution seeks the efficiency and liquidity that on-chain government debt provides. This will be the foundational layer, the risk-free tokenized asset upon which this new digital economy is built. The second major wave will be in high-value, traditionally illiquid assets. I'm talking about commercial real estate, private equity, and venture capital. Think about a new skyscraper being built in downtown Austin. Today, funding that project is reserved for a handful of massive institutional investors and private equity firms. With tokenization, the developer could issue tokens representing equity in the building itself. Suddenly, accredited investors across the country could buy a $10,000 stake, a $50,000 stake, gaining direct exposure to an asset class that was previously locked away. By 2026, we will see the rise of SEC-regulated platforms that specialize in this, creating the first real liquid secondary markets for these assets. An early investor in a private tech company won't have to wait 10 years for an IPO to get their money out. They can sell their tokenized shares on a secondary market after 3 or 4 years, unlocking capital and fueling more innovation. The third, and perhaps most culturally significant trend, will be the tokenization of collectibles and alternative assets. Think fine art, classic cars, rare whiskeys, and even sports team ownership. Imagine owning 1/10,000th of a Picasso, or a 0.01% share of your favorite NFL team. These are passion assets that have also been incredible stores of value, but accessible only to the ultra-rich. Tokenization democratizes access. It allows a regular person to invest a few $100s in the things they love and understand, diversifying their portfolio beyond just stocks and bonds. By 2026, we'll see major auction houses like Sotheby's and Christie's expanding their digital divisions beyond NFTs of digital art and into the tokenized fractional ownership of physical masterpieces. This isn't just a technological shift, it's a philosophical one. It's a move from a world where ownership is opaque, slow, and expensive to one where it is transparent, instant, and accessible. It means your future 401k might not just hold mutual funds. It could hold a sliver of a solar farm in Arizona, a piece of a venture capital fund investing in AI startups, and a fraction of a royalty stream from a hit song. Your wealth will be more diversified, more liquid, and more directly tied to the real-world assets that power our economy. This is the future Wall Street is frantically building behind the scenes. Using the rails of blockchain technology, they see the writing on the wall. The old world of siloed illiquid assets is dying. In its place, a new tokenized economy is emerging where any asset can be owned by anyone, anywhere, and traded in an instant. But this raises a profound and critical question. If every asset in the world is about to become a token on a blockchain, who exactly is holding these tokens? How do you prove that you are the rightful owner of your tokenized house, or your tokenized shares, or your tokenized art? You can't just use an anonymous crypto wallet address. For this regulated real-world system to work, you need a secure, verifiable, and universally accepted way to prove who you are in the digital world. You need a digital identity, and the race to build that is the next great battleground that will define our digital lives for the next century. This new battleground isn't about who has the fastest chip or the biggest data center. It's about who owns the master key to your digital life. Right now, you don't. Think about it. How many online accounts do you have? 10? 50? 100? Each one has a separate login, a separate password you're not supposed to reuse but definitely do, and each one holds a tiny, isolated sliver of you. Your Amazon account knows what you buy. Your Netflix account knows what you watch. Your bank knows your finances, and Google knows, well, Google knows pretty much everything else. Your identity is shattered into 100 digital pieces, stored in 100 different corporate safes. And here's the kicker. Those safes are not that safe. We see it every single week in the headlines. A massive data breach here, millions of passwords stolen there. Your personal information is being bought, sold, and stolen constantly because the very architecture of our digital world is broken. We've built a global communication network on a foundation of digital quicksand. Every time you log in somewhere, you're handing over the keys to a piece of your life, trusting that the company on the other end will be a good steward of your data. It's a handshake deal repeated billions of times a day, and our hands are getting dirty. The crypto world's answer to this chaos is a concept so profound it sounds like science fiction. It's called self-sovereign identity, or SSI. The name says it all. You are the sovereign. You are the king or queen of your own data. It flips the entire model on its head. Instead of your identity being stored by corporations, it's stored by you, in a secure digital wallet on your phone or computer. This isn't a wallet for money. It's a wallet for facts about you. Think of every piece of your identity as a verifiable credential. Your driver's license, issued by the DMV, that becomes a digital credential, cryptographically signed by the DMV to prove it's legit. Your college diploma, a digital credential signed by your university. Your passport, signed by the State Department. Your concert ticket, signed by Ticketmaster. You hold all these credentials in your private, encrypted wallet. Now here comes the magic. Let's say you want to log into a new social media site in 2026. The site needs to know you're a real human and not a Russian bot. Instead of creating a new username and password, you just connect your identity wallet. The site asks for proof of humanness, maybe from a credential issued by a trusted third party. With a click, your wallet provides a cryptographic proof that you hold that credential. The site doesn't learn your name, your age, or your address. It only learns the one single fact it needs to know. You are a verified human. You're in. No password created, no personal data handed over. Let's take it a step further. Imagine you're buying a bottle of wine online. The website's only legal requirement is to know that you are over 21. Right now, you might have to upload a photo of your driver's license, giving them your name, address, date of birth, driver's license number, a treasure trove of personal data just to prove one single fact. It's like using a sledgehammer to crack a nut. With self-sovereign identity, the website would simply ask your wallet, is this person over 21? Your wallet, using a technology called a zero-knowledge proof, would respond with a simple, cryptographically verifiable, yes. That's it. The website learns that you are of legal age and nothing else. It doesn't get your name, your birth date, or what you look like. You have proven a fact without revealing the underlying data. This isn't a distant dream. The technology for this exists today, and is being refined by some of the biggest companies and brightest minds in the world. By 2026, we're going to see this shift from theory to reality in the United States. Think about the implications for finance. The dreaded KYC process, Know Your Customer, where you have to upload your passport and a utility bill to every single financial app you use. It's a massive point of friction. In an SSI world, you would get your identity verified once by a trusted institution like your bank. They would issue a verified person credential into your wallet. Now you can use that single credential to instantly onboard with any brokerage, any crypto exchange, any lending platform, all without resubmitting your private documents over and over again. This would be a monumental unlock for both traditional and decentralized finance, making it safer, faster, and more private. Consider healthcare. Your entire medical history, every doctor's visit, every prescription, every lab result, could exist as a set of verifiable credentials in your wallet. When you visit a new specialist, you grant them temporary, specific access to the relevant parts of your history. No more filling out 100 pages of paperwork. No more faxing records between offices. You control who sees your most sensitive information and for how long. Puts HIPAA on steroids, giving the patient ultimate control. And yes, let's talk about the most contentious topic in America: voting. A huge part of the debate centers on voter ID and election security. Imagine a system where the Board of Elections issues a registered voter credential to every eligible citizen. To vote, you would anonymously present proof that you hold this credential. You could prove you are eligible to vote in your district without revealing who you are, solving the voter ID issue while preserving the sacred privacy of the ballot. It could fundamentally change the nature of trust in our democratic process. This is the future that's being built right now, quietly in the background. It's not just a single crypto project. It's a new standard for the internet, like TCP, IP, or HTTP before it. The Decentralized Identity Foundation includes members like Microsoft, who are building their ION identity network on top of Bitcoin. You have projects like WorldCoin, controversially, trying to solve the proof of personhood problem. You have established enterprise players and scrappy startups, all racing to build the platforms and wallets that will custody our new digital selves. The transition will be gradual. By 2026, it won't be everywhere, but it will be emerging in key sectors. You might see a pilot program for a digital driver's license in a state like Colorado or Utah. You might see major banks begin to offer identity verification as a service. You'll see crypto-native applications adopt this as the standard way to log in, eliminating the risk of exchange hacks that steal user passwords. What we are witnessing is the construction of a new trust layer for the internet. For the past 30 years, our trust has been based on platforms. We trust Google, we trust our bank, we trust the government. The next era will be based on verifiable cryptographic truth. You won't have to trust the platform. You'll just have to trust the math. And the math doesn't lie, get hacked, or sell your data to the highest bidder. This is about more than convenience. It's a fundamental shift in the power dynamics of the digital age. It's about taking back ownership of the most valuable asset we have, our own identity. It's a digital declaration of independence. But this raises an even bigger, more mind-bending question. If we can create a secure, verifiable, sovereign identity for every human on the planet, what happens when we start giving identities to things that aren't human? What happens when a self-driving car has its own identity wallet to pay for charging and tolls? What happens when an artificial intelligence has a sovereign identity to prove its credentials and own its own intellectual property? What happens when an entire company is run not by people, but by a decentralized network with its own verifiable identity? That's where the fabric of our economic and social reality begins to truly unravel and reform into something new. And this unraveling leads us directly to our next monumental trend, one that takes the abstract power of the blockchain and welds it directly onto the physical world we all live in. It's called the tokenization of real-world assets, or RWAs. And by 2026, it will begin to feel less like a niche crypto experiment and more like the single biggest wealth-unlocking event of our generation. Think about the most valuable things in our economy: commercial real estate in downtown Manhattan, a portfolio of fine art, a private, family-owned business that's been successful for 50 years. What do they all have in common? They are profoundly illiquid. You can't just sell the lobby of a skyscraper or one brushstroke of a Monet painting. Ownership is a monolithic block. If you own a $2 million apartment building, you have $2 million in assets on paper, but you might have trouble paying for groceries if rent is late. To access that value, you have to sell the entire thing. A process that involves armies of brokers, lawyers, appraisers, and months, if not years, of paperwork. Your wealth is trapped inside a fortress of inefficiency. This is the problem that RWA tokenization is built to solve. It's a beautifully simple concept with world-altering implications. You take a real-world asset, a building, a gold bar, a forest, a shipping container full of goods, and you create a digital representation of it on a blockchain. This digital representation, this token, is like a digital deed. But here's the magic. You don't have to issue just one token for the entire asset. You can issue 10 million tokens. Each token now represents a tiny legally backed fractional share of that asset. Suddenly, that $2 million apartment building isn't a single immovable block of value anymore. It's 2 million digital shares that can be bought, sold, and traded instantly 24/7, anywhere in the world with minimal fees. You've taken the most illiquid asset class on Earth, real estate, and given it the liquidity of a stock. You want to free up $50,000 for a new business venture? You don't need a bank loan with crippling interest. You just sell a fraction of your building's tokens on a decentralized exchange. The transaction settles in minutes, not months. The ownership transfer is recorded immutably on the blockchain, visible to everyone, eliminating the potential for fraud and the need for costly title insurance. By 2026, this won't just be a theory. The groundwork is being laid right now by the biggest financial institutions on the planet. When the CEO of BlackRock, the world's largest asset manager with over $10 trillion under management, says that the next generation for markets, the next generation for securities, will be tokenization of securities, you have to understand that the floodgates are about to open. This isn't a crypto-native fantasy. This is Wall Street recognizing the sheer, undeniable efficiency of blockchain technology. So what does this mean for the average American? It means the democratization of investment on a scale we've never seen before. For the last century, the best wealth-generating assets, private equity, venture capital, commercial real estate, fine art, have been the exclusive playground of the ultra-wealthy. You needed millions just to get a seat at the table. Tokenization shatters that barrier. Imagine opening an app on your phone in 2026. You can browse through investment opportunities that were once impossible to access. You could buy $500 worth of a luxury hotel in Miami, earning a proportional share of its rental income. You could invest $1,000 into a portfolio of tokenized fine wine, an asset class that has historically outperformed the S&P 500. You could buy tokens that represent a stake in a promising new biotech startup before it ever goes public. You could even buy tokens representing a share of the future royalty payments of your favorite musician's next album. This transforms every American from a simple consumer into a sophisticated investor. Your wealth is no longer confined to a 401k and maybe a home. You can build a truly diversified global portfolio of tangible, income-producing assets, one microshare at a time. It's the same revolutionary leap that the stock market created a century ago, allowing everyday people to own a piece of the great industrial companies. RWA tokenization is the 21st century version of that, but for everything else of value in the world. And the impact goes beyond just investing. Think about small businesses. A local restaurant owner who needs to raise capital for an expansion no longer has to beg for a bank loan. They can tokenize a portion of their future revenue and sell those tokens to their own loyal customers, turning their community into their biggest investors. The customers get a direct financial stake in the success of a business they love, and the owner gets capital without giving up control to a venture capitalist or a bank. It's a new hyper-localized form of capitalism powered by a global decentralized technology. Now let's be clear. The road to a fully tokenized world by 2026 is not without its bumps. The legal and regulatory frameworks are the biggest hurdle. How does the law recognize a digital token as true ownership of a physical object? What jurisdiction applies when an investor in Japan buys a token representing a piece of a building in Texas? How do you perform accurate, real-time valuation of these assets to prevent market manipulation? These are complex questions, and regulators are moving cautiously, as they should. The technology is writing checks that our current legal system can't yet cash. But the sheer gravitational pull of the efficiency and liquidity that tokenization offers is too strong to ignore. The trillions of dollars currently locked up in illiquid assets represent a reservoir of dormant economic energy. Tokenization is the dam-breaching technology that will unleash it. We're not just talking about creating a new market. We're talking about creating a new financial substrate for the entire global economy. By 2026, you will see the emergence of specialized, regulated platforms for trading tokenized real-world assets. Your standard brokerage account might have a new tab, right next to stocks and ETFs, labeled tokenized assets. The conversation will shift from, what is Bitcoin? To what percentage of my portfolio should be in tokenized infrastructure bonds versus tokenized agricultural land? This is the bridge between the digital and physical realms, between DeFi and traditional finance. It's the mechanism by which the abstract value floating in the cryptosphere gets anchored to real, tangible things. It provides legitimacy, stability, and a use case so profound that it will force the entire financial industry to adapt or become obsolete. Because once you give the world a taste of instant liquidity and transparent ownership, there is no going back. The old, slow, expensive way of doing things will look as archaic as sending a letter by horse-drawn carriage. But as we connect everything of value in the physical world to this new digital layer, another, even more profound question emerges. How do we manage this infinitely complex, interconnected web of value? How do we ensure it operates not just efficiently but fairly and intelligently? The answer lies in merging this new financial plumbing with the most powerful technological force of our time. The answer is artificial intelligence. And I know what you're thinking. AI. It's the ultimate buzzword. It's slapped onto everything from your toaster to your toothbrush. But when we talk about merging AI with the native digital economy of crypto, we are not talking about a marketing gimmick. We are talking about a fundamental evolutionary leap. We're talking about giving the global financial machine a brain. Think about the current state of crypto, even the most advanced DeFi protocols. They are incredibly powerful, but they are also passive. A liquidity pool just sits there. A lending protocol just executes the code it was given. They react to user commands, but they don't think. They don't strategize. They don't adapt. All the intelligence, all the strategy still has to come from us, the fallible, slow, and emotionally driven human user. You are the one who has to decide which pool to enter, when to harvest your rewards, when to rebalance your portfolio. You have to stay awake for 24 hours a day, 7 days a week, monitoring thousands of variables across a dozen blockchains to truly optimize your position. It's an impossible task. We've built a financial system that operates at the speed of light, but we're still trying to manage it at the speed of human thought. This is the bottleneck. By 2026, this bottleneck will be shattered. The major trend isn't just crypto, and it isn't just AI. It's the synthesis of the two. We're about to witness the rise of autonomous economic agents. So what is an autonomous agent? Forget chatbots that can write a poem for you. Imagine a piece of software that lives on the blockchain. It has its own wallet. It has a defined set of goals, for example, preserve capital and generate a 15% annual yield. And it has the AI-powered intelligence to execute a strategy to achieve that goal completely on its own. It's not just an algorithm. It's a learning, adapting economic entity. Let's make this real. What does this actually look like in 2026? First, we have AI-powered portfolio management that makes today's robo-advisors look like abacuses. Your AI agent won't just buy and hold a basket of assets. It will be an active, relentless DeFi yield farmer working on your behalf. It will constantly scan the entire on-chain universe, every liquidity pool, every staking opportunity, every lending protocol across multiple blockchains. It will calculate risk-adjusted yields in real time, factoring in everything from transaction fees, to the risk of smart contract exploits, to the underlying stability of the protocol's governance. It might see that a liquidity pool on Arbitrum is offering a slightly better yield for an hour, so it will instantly and automatically move your capital there, execute the transaction, and then move it back once the opportunity disappears. It will perform complex strategies like delta-neutral farming, which requires constant rebalancing that is simply too tedious and fast-paced for a human to manage effectively. This isn't just about making more money, it's about democratizing access to financial strategies that, until now, were the exclusive domain of elite quantitative hedge funds with armies of PhDs. In 2026, you could have a personal on-chain quant fund in your pocket. Second, this trend goes far beyond just managing your own money. It's about managing the entire system. AI agents will become the essential immune system and central nervous system for the crypto economy. Think about security. Right now, smart contract audits are a snapshot in time. A human team reviews the code once. But what about new attack vectors that emerge later? AI agents will perform continuous, real-time security audits on live protocols. They'll monitor transaction flows for patterns that suggest a hack or an exploit is underway. And they can automatically trigger protective measures, like pausing a contract or moving funds to a secure vault, faster than any human team ever could. Think about oracles, the services that feed real-world data like the price of a stock or the weather into the blockchain. AI-powered oracles won't just report a single price feed. They will synthesize millions of data points, from market sentiment on social media, to satellite imagery of oil reserves, to macroeconomic indicators, to create a far more robust, accurate, and manipulation-resistant source of truth for the entire DeFi ecosystem. This makes everything built on top of it stronger and more reliable. Third, and this is where it gets truly transformative, is the emergence of AI-driven organizations. We're not just talking about automating tasks, we're talking about automating the entire firm. Imagine a decentralized venture capital fund, a DAO, where the investment decisions are not made by a committee of humans voting, but by a collective of AI agents. These agents would crawl the web and the blockchain, identifying promising new projects, analyzing their code, their team, their community engagement. They would then propose investments, execute the funding, and actively manage the portfolio of tokens, all without a single human in the loop for the day-to-day operations. The humans are there to set the grand strategy, to define the values and the goals. The AI is there to execute it, flawlessly and without emotion 24/7. This is where the United States becomes the critical battleground and incubator for this trend. The fusion of the world's leading AI research hubs in places like Silicon Valley and Boston with the burgeoning crypto development scene creates a perfect storm for innovation. The capital is here. The talent is here. But the regulatory challenges will also be front and center here. When an autonomous AI agent with $1 billion in its wallet makes a trade that destabilizes a market, who is responsible? Is it the person who deployed it? The developers who wrote its code? Or is the agent itself a new kind of legal entity? These are the questions that the SEC, the CFTC, and Congress will be wrestling with by 2026. The legal frameworks created in the US will set the precedent for the rest of the world on how to deal with non-human economic actors. Furthermore, this convergence will force a massive shift in the American workforce. The job of a traditional Wall Street trader or portfolio manager becomes infinitely harder when your competition isn't another human, but an AI that can analyze more data in a second than you could in a lifetime. The new high-value skills won't be in executing the trades, but in designing the AI agents that do. The new jobs will be AI agent strategist, protocol ethics auditor, and decentralized AI trainer. What we are witnessing is the birth of a new economic intelligence layer for the internet. It's an active, thinking layer that sits on top of the passive, transactional layer of the blockchain. It's the ghost in the machine. A machine that is, for the first time, capable of managing its own complexity, securing its own infrastructure, and intelligently allocating its own resources. This isn't science fiction. The foundational pieces are being built right now by projects focused on decentralized computing, AI model marketplaces, and on-chain intelligence. By 2026, these pieces will begin to coalesce into something cohesive, something powerful, and something that will fundamentally change our relationship with finance and technology. We are on the verge of creating a system that can not only think but can act on a global economic scale. But this raises the most profound question of all. As we build this autonomous financial world, one that is more efficient, more intelligent, and more powerful than anything that has come before, what is our role within it? That question isn't a sign of our obsolescence. It's the sign of our liberation. For centuries, our role in the economy has been defined by our limitations. We were the labor, the calculators, the middlemen, the processors. We filled the gaps that technology couldn't yet bridge. We were the cogs in a machine designed by someone else, a machine that often ran on our time, our energy, and our data with little compensation for the true value we provided. As we look toward 2026, the convergence of these trends, AI, DePIN, tokenization, and clear regulation, is not building a world without us. It's building a world that no longer needs us to be cogs. The machine is becoming self-sufficient. The ledgers are self-auditing. The networks are self-governing. The intelligence is self-improving. So what is left for us? Everything that matters. Our new role is to be the architects, the visionaries, the ethicists, the creators. Technology is becoming a master of how. It can execute tasks with flawless precision and efficiency, but it can never answer the question of why. Why this goal? Why these values? Why this direction? That remains the exclusive and sacred domain of human consciousness. Our role is to imbue these autonomous systems with purpose. We are the ghost in the newly intelligent machine. Think about the creator economy. For the last 2 decades, Web 2 platforms have allowed us to create content, but they own the distribution, the data, and the majority of the revenue. You were a tenant on their land. In the Web 3 paradigm that will be mainstream by 2026, you are the sovereign owner of your digital identity and your creations. Tokenization, through NFTs and social tokens, allows a musician to give their fans direct ownership in their success, not just a link to a streaming service. It allows a writer to build a decentralized media company, owned and operated by their readers. It allows an artist to earn royalties in perpetuity every time their work changes hands, long after they're gone. Our role is no longer to be the content for the platform. Our role is to be the platform. We are not just creating. We are building microeconomies around our work, our communities, and our ideas. The American dream has always been about ownership, owning a home, owning a business. The 2026 version of that dream is about owning your digital life, owning a piece of the internet itself, and owning the value you create within it. And what about governance? In the old world, our role was to vote once every few years for a representative who we hoped would act in our best interest. In the new world of decentralized autonomous organizations, or DAOs, our role is to be active stewards of the systems we use every day. By 2026, you won't just be a user of a financial protocol. You'll be a voting member. You'll have a say in the fee structure, the next software update, the treasury management. This is a radical shift in responsibility. It's a move from passive consumption to active participation. It demands more from us, not less. It requires us to be more informed, more engaged, and more collaborative. The code may be law, but we, the community, are the legislature. We are the ones who will debate the ethics of an AI-powered asset manager. We are the ones who will vote on how a decentralized energy grid allocates its resources. Our role is to provide the moral compass for this automated world. This leads to perhaps the most critical role of all: the educator and the bridge builder. The gap between the crypto native and the average American is still a chasm. The greatest challenge for 2026 isn't the technology. It's the user experience. It's the language. It's the onboarding. Our role as early adopters and believers is not to gatekeep this knowledge with complex jargon and insider speak. It is to build the bridges, to design the intuitive interfaces, to create the simple, compelling educational content that allows our parents, our friends, and our neighbors to cross over with confidence. The killer app for crypto won't be a single piece of software. It will be a user experience so seamless, so integrated, that people won't even know they're using a blockchain. They'll just know they're getting a better deal on a loan, that they're earning a yield on their data, or that they truly own their in-game items. And our role is to be the architects of that simplicity, to hide the complexity so that everyone can benefit from the power. So let's bring it all together. Let's paint the picture of 2026. The regulatory clarity we've been waiting for has arrived. It's not a hostile takeover but a set of foundational rules, like the building codes for a new city. This clarity has unleashed a torrent of institutional capital and Main Street trust. Your 401k now has a professionally managed allocation to digital assets. Major banks are not just custodying Bitcoin. They are tokenizing investment funds and using blockchain for instantaneous settlement. The uncertainty that held so many back has evaporated, replaced by the legitimacy of a new asset class, fully integrated into the American financial landscape. In this landscape, tokenization has unlocked trillions of dollars of illiquid value. A young entrepreneur in Ohio doesn't need to go to a venture capitalist. She can tokenize equity in her startup and raise capital from her own community, her earliest and most loyal customers. A family can take out a mortgage against a fraction of their home's value without the paperwork and fees of a traditional bank, using a decentralized lending protocol. Real estate, art, private equity, the entire physical world is being mirrored on-chain, creating a liquid, programmable, and accessible market for everyone. This new economy runs on a physical infrastructure that you, the people, own and operate. DePIN has turned everyday devices into revenue-generating assets. The wireless hotspot in your window is providing 5G coverage to your neighborhood and earning you tokens. The spare computing power on your gaming rig is processing complex AI models for researchers, and you're being compensated for it. The solar panels on your roof are selling excess energy directly to your neighbors on a peer-to-peer grid. We've moved from a world where a few megacorporations own all the infrastructure to a world where the infrastructure is owned by everyone who uses it. And overseeing it all, optimizing it all, is the powerful synergy of AI and crypto. Autonomous AI agents representing you are constantly scanning decentralized markets to find the best yield for your savings, the lowest cost for your insurance, the most efficient use of your digital assets. This isn't some far-off science fiction. This is the practical application of these technologies, working in the background to create a more efficient, personalized, and equitable financial system. It's an economy that is not just connected, but intelligent. And at the very center of it all is you. Not as a user, not as a consumer, not as a data point to be sold. You are the owner, governing the protocols you rely on. You are the creator, capturing the full value of your talent. You are the investor, accessing markets once reserved for the ultra-wealthy. You are the architect, debating and defining the values of this new world. The transition we are living through is as profound as the shift from the agricultural to the industrial age, or the industrial to the information age. We are witnessing the birth of the autonomous age. And it can be terrifying because it demands we let go of old certainties. But it is also exhilarating because it offers us a new mandate. Our role is not to simply watch these trends unfold. Our role is to shape them, to build with them, to infuse them with our values of freedom, ownership, and opportunity. 2026 is not a date on a calendar we are waiting for. It is a future we are building line by line of code, conversation by conversation, choice by choice right now, today. The great project of our generation is to build a digital world that is more free, more fair, and more human than the physical one we inherited. And our role is simply to begin.